welcome to another video from Creativo Solutions. You're watching the Accounting for Non-Accountants video series. Please post comments and questions below. I want to hear from you what challenges you're having with accounting. Remember, most of you watching this are probably non-accountants, so you're professionals in a particular area of business and you're wanting to improve your skills in terms of the accounting that you deal with on a day-to-day basis, perhaps part of your budgets for your department. Right guys, please subscribe to this channel and visit the website for more content and more resources to help you. For today's video, we're going to be looking at the principle-based approach again, and we're going to expand on the actual accounting process. Right, so what are we actually going to need to actually get the information that's so valuable for the decision makers? Right, so the first bit that we need to revise from the previous video, if you haven't watched that video, please go back and view video number 3, covering the accounting language of doing business. Right, so in this particular module, we're focusing on the process. We know that decision making is the end goal. We need good information to make reliable decisions. We can't make a decision if we don't even understand the information. So we need to have the ability to read and to interpret the language being used. And that's why accounting is so important, purely because it's a way to convey financial information. And that's what we're trying to learn. We're trying to learn about the principles, because principles are universal. And we know those universal principles or rules will always be implemented. So if we understand those rules, we'll know how to deal with certain situations, and that helps with the decision-making process. We've got a diagram here with input, processing, and output. In terms of the nature of accounting, we spoke about accounting being based on certain fundamental principles. Right, so we know that things need to be understood, they have to be familiar, there has to be some sort of standard way of achieving the end result, which in this case is the set of financial statements. Right, so I want you guys to think about what is the input. Okay, if you watched the previous video, you'll probably have a good idea of what the input is. So take a minute and think about these 3 questions. What is the input? What is the output? And most important for today's video, what is the actual process? Take a minute to think about those 3 and then we'll cover the theory. So, what is the input? There's the answer, a business transaction. Remember, transactions involve 2 parties, the buyer and the seller. And the buyer and seller would enter into a transaction whereby goods and services will be exchanged for cash. And the second question is, what is the output? Well, I hope you gave this some thought, and we actually spoke about it in this video a few minutes ago, financial statements. We know we need information to make good decisions. So the output that the accounting process is going to provide us with is the financial statements. There are different financial statements, and we'll learn about those more at a later stage. For now, the input is the business transaction, the output is the financial statement. What is the actual process then? Well, the process can be quite complicated in terms of all the different checks and balances that need to be done in order to get the end results. To summarize it, we're going to be looking at the financial cycle. Okay, we're going to be looking at it at a very broad level. Okay, we're not going to look at all the detail that's going to form part of the accounting system, right? But that forms part of a business's operations. Okay, so how does the business do certain things? What are the steps that need to be taken in order to get to the end result? The process involves a system. In today's world, everything is digital and electronic, so a computer accounting system would help generate the output by processing the data that they would have received from all the different transactions. And that creates the financial accounting cycle. Just to visualize all of this in a diagram format, the accounting process, we know step number 1 is the transaction. Transactions have two sides, buyer and seller entering into an agreement. Okay, remember, transactions can have, let's say, relevance in terms of being very material and very important to the business, okay, purely based on its monetary value. So transactions need to be recorded, and transactions have to have proof that they have occurred. So source documents help us to keep track of those transactions. Without a source document, no one knows if a transaction actually occurred. Right, so if we're entering into an agreement, and I'm going to be giving you a particular product, and you're going to be giving me cash in return, we need some sort of proof that that transaction has occurred. Did I receive the cash from you? Did you receive the goods from me? So that transaction needs to be recorded, and the source document helps us with acknowledging that a transaction did indeed occur and that there is some sort of proof that we can use to then generate our accounting records. Because remember, it's all about record keeping. So step number 3 is journals and ledgers. Right, those are fancy accounting terms that refer to almost like a filing system, okay, or a classification system. We're trying to take all those source documents and we're trying to group them in a particular book. The book is called a journal, okay, or a ledger. In reality, it would be maybe a file on a computer system. Okay, a computer accounting system would then keep track of all those types of transactions. So you do get different types of journals and ledgers. Okay, ledgers focus more on specific accounts, right, which we'll learn about later in more detail when we look at more of the elements of accounting. We spoke about that in a previous video. And journals would be books that actually that keep or collect all of the similar types of transactions. So for example, if I go to store A and I purchase stationery, okay, for the business, then I go to store B and I purchase consumables for the canteen. Right, so you've got stationery and you've got consumables. Both have been bought using cash. So those are both cash transactions. Because I've purchased something, that'll be seen as a cash payment. Okay, that's just one example of a transaction that would meet a specific classification group, okay, i.e. your payments. Right, so to make the accounting process simpler, we're trying to group similar types of transactions. So all our payments will be grouped as payments, all our receipts could be grouped as receipts, and so on, depending on the number of transactions that we have as a business. So what do we do with all of these journals and ledgers? Okay, remember, these are accounting records. Well, someone needs to check that those records are accurate. Remember, the end result we spoke about is what? The financial statements. There's no point generating a set of financial statements if those books aren't accurate, and if there are mistakes or errors, the financial statements aren't going to be reliable and accurate. And that's why we've got the trial balance. The trial balance is going to help us check that everything balances. Okay, balances, we'll learn about the double entry rule at a later stage. I'll mention that. We've actually spoken briefly about it before, where there's two sides to every transaction. So even with the accounting, the record keeping, there's still going to be two sides to every transaction. Okay, we'll refer to that more at a later stage. So in terms of the trial balance, we're checking that one side of an account equals the other. Okay, or the debit side of an account equals the credit side of the account. Okay, these are just fancy terms that the accountants use to describe the left-hand side or the right-hand side of a particular account. It's like a scale. The scale needs to balance. Both sides need to have the same weight so that there isn't more on the one side compared to the other. And that's exactly what you're doing from an accounting point of view. You're checking that transactions have been recorded accurately. So now we know transactions are accurate, we can then generate a set of financial statements. And this is the information that we spoke about previously. Information is key. Why? Because information will allow users to make decisions. So the final step would be the decision-making process. Now we've got the information, we can look at the information and we can strategize, we can form certain plans going forward, and we can then decide on which is the best option to choose for the business's best interests. Okay guys, so that's the accounting cycle. Just to summarize all of that in a step-by-step process, we spoke about a transaction. We know that you get different types of transactions. Cash and credit are the more common ones. You do get others as well. Then we know those transactions must be recorded where? Well, in the source document. That's step number 2. Source documents record transactions, so they act as the proof. We need to then take those source documents, which could be in the form of an invoice, a receipt, an EFT, a debit or a credit note. It could be anything that represents a transaction, and those need to be recorded in a journal. A cash journal, we get credit journals, we get general journals. They're all different books, or let's say classification boxes that group similar types of transactions. And then we've got the ledger, which is summarizing separate accounts. Okay, so we'll be looking at how much did I spend on a particular area of the business. Okay, did I buy 1, 2, 3 million rand worth of stationery? It all depends on the number of transactions that occurred during the financial year. Then we've got the trial balance, and the trial balance is going to check that everything matches. Okay, debits and credits are equal, the left and the right are equal, there aren't any errors or suspected errors or obvious errors in the actual accounting process. Right, if we know that the trial balance is balancing, we can then generate the financial statements. Right, and the financial statements will convey a whole host of different information. It could be information relating to the financial position. It could be information relating to the financial performance. It could relate to cash flow and even the equity of that particular business. And that's the accounting process. We've reached the end of this video, guys. Please subscribe to the channel and please comment below. Tell me about your experience in terms of the accounting cycle. How involved are you with the cycle? Are you currently writing tests and exams? Are you actively generating a set of financial reports? What sort of questions do you have about the accounting cycle? Comment below. Send me your questions. Make sure you subscribe to the channel. Hit the thumbs up button if you liked the video. Thank you so much for watching.